Q1 has been fantastic, but I think looking at the year as a whole, you're going to see that most of the returns are very much front-loaded, so a much weaker Q2, a much weaker Q3, and then maybe in Q4 we can see some kind of pickup. And the main reason for that is Q1 was really lifted by the Fed's dovishness and certainly optimism about US and China, and it allowed markets to almost ignore what was going on in the actual economic dynamics and the underlying economy. And now, as we're getting to Q2, we've seen over the last few weeks that markets are now starting to refocus on the economic fundamentals. It has been somewhat disappointing, weakening growth in the US, weakening growth in Europe, and still waiting for signs of stabilization in China. And that, I think, is really going to weigh on risk assets over the coming months. Now, that's not to say that risk assets aren't going to outperform, but they're going to have a much weaker performance than we saw in Q1.
Here's the confusing part, I think, for many CNBC viewers. On one hand, they're hearing about this amazing start to the year. Small caps, their best start to the year in decades. On the other hand, you've got this inverted yield curve, the 310s, whatever you want to call it, on negative yields in Germany, which people say, well, there you go, that's a global slowdown. How do you square the two?
Well, look, as I said, we've had that first quarter where markets have really not focused on what's going on with the economy. And in the last few weeks, we've had the Fed and the ECB both come in with weaker expectations for growth. We've had downgrading of interest rates forecasts as well. And now markets are starting to wonder, does the central bank know something that we don't know about what's going on in the global economy? And that's why you've seen bond yields across the globe fall like they have. And then what we were now waiting for is for equity markets to catch up. I would say, though, that, look, it does seem like global bond markets have almost exaggerated their reaction. We certainly do not expect to see recession later this year, and certainly maybe not even into 2020. So there has been a slight exaggeration. So for that reason, I actually don't like to be in global bonds right now. I think there could be quite a sell-off later on. And at the same time, I think equity markets have to come in. So you're going to have a meeting in the middle somewhere.
You don't want to be in government bonds, but equity markets, as you just said, have to, quote, come in. So where's the best investment idea right now, Seema?
Look, I think the key thing is when you have an economic slowdown, not a recession, but a slowdown, you have to have some kind of pivoting on your portfolio allocation. So you're looking more at defensives over cyclicals. You're thinking about stuff like consumer staples, healthcare, REITs. Certainly, if you don't see a recession and you don't see inflation picking up too much and rates staying where they are, this is actually a pretty good time for real assets. And then at the same time, because we actually expect the Chinese economy to be picking up at some point in the second half of the year, that should also start lifting emerging markets even further. So I actually think it's a case of global pivoting more towards emerging markets and also positioning yourself more in defensives rather than cyclicals.
Seema, right now, as we speak, there is yet another vote about to happen in the UK Parliament. The MPs, ministers of Parliament, they're debating again Theresa May's Brexit plan. Third time, it's failed the first two. Most people aren't expecting it to pass. But what if we get some surprise announcement where a deal is struck, where a so-called hard Brexit doesn't happen? You're there. Does that make you more bullish on UK stocks, on European stocks, on American stocks? I think anything which we consider as good news is something which eradicates the idea of having a no-deal Brexit. So as long as you don't have a hard Brexit, this is a positive. I think for sterling markets, and that's probably the one thing that most people are watching most closely, because that's the easiest way to interpret what's going on with Brexit, is that sterling wants certainty. What they want to see is they don't want to see a change in government. They want to see this Brexit dialogue actually being finished sooner rather than later. So I think the best case scenario from a sterling perspective right now would be that Theresa May's deal passes today and then you actually get Brexit coming to an end within the next couple of weeks. Quickly, is a hard or no deal Brexit already priced in?
No, if it was to be priced in, you'd see sterling much, much lower than where it is today.